Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Thanos. It's fantastic to have you on the podcast show.
Thank you. Thank you very much, Bilal. Always a pleasure to see you. It's been a while.
Absolutely. Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So it'd be great to know something about what you studied at university. Was it inevitable you would end up in finance, and what you're up to right now?
Thank you. Totally. Well, I'm Greek. Originally, I came here to study from Greece. I studied economics, and then I started working with the UK government as a government economist before moving to asset management. So it was from economics to asset management. At the time, I preferred asset management rather than trading because asset management had more links, if you like, with the broader global macroeconomic environment. That was always interest of mine. Even from economics, it was more macroeconomics rather than macroeconomics. And I felt like that was an opportunity to be able to present the views and then see the impact they were having from the financial market. And then it was asset management for 20 years.
Okay, great. And what was it like working for the government? Because obviously you were private sector for most of your career, but then you had this first step into government.
It was amazing. The people, the culture, the work, and the only issue, if you like, which was one of the attractive areas of moving into asset management, was that as an economist, as a government economist, the minister would come to you, and William Hague was my minister at the time. So they'd come to you and they'd say, well, we're thinking of doing this particular project and would like you to come up with the analysis and give us your three options. And you would go, option A is, in our view, the most attractive. Option B is somewhere in between, and option C is the least attractive. And as an economist, that's what you do. And then the policymakers would come back and say, thank you very much, we're going to go for option C. Or thank you very much, great, we'll park everything and we'll consider it again in 5 years' time. So the frustration, if you like, is that you do a lot of analysis, but you can't really put your neck on the line. It's not up to you. And that's where the beauty about asset management, as you very well know, is that you have a view and then you can put your neck on the line and see whether you're right or whether you're wrong. And I appreciated that. But working for the government was amazing. And the civil service.
That's great to hear. Now we're here to talk about markets and geopolitics and what's going on in the world. And it's hard to not talk about Trump. So let's start with Trump. This is a question I've been asking all of my guests this year, is how do you see Trump 2.0 versus Trump 1.0? What's the big sort of difference in terms of the administration?
I don't think there is a big difference between Trump 1.0 and 2.0. And the most key, if you like, focused on is the way that he's dealing with the allies. And two surprises for me in terms of the recent developments. Surprise number one was that the Europeans were sort of astonished, including the Canadians and the Mexicans, with what he's been saying and what he's been doing. Now, one, we should not be astonished with what he's been saying and what he's been doing. Trump 1.0, if you remember, the first G7 meeting that he went to, I can't remember if it was in Cannes at the time. It was the first G7 meeting that he went to. He turned around and said, guys, where's Vladimir? And they said, well, this is G7, it's not the G8. Russia is not part of it. He said, how can you have a G7 meeting or G8 meeting without Russia? You need Russia here. Number one. Number two, he did go immediately in terms of breaking down NAFTA. The first points of contact were Canada and Mexico. The transatlantic relation cracked. He rightly said that Germany was highly reliant on Russian energy. The Nord Stream was not appropriate. Correctly also that the Europeans were not paying their fair due on NATO. And why should Texans and Arizonians subsidize Portugal, Spain, Luxembourg, Germany, and so on? So in my view, there were a number of things which I may not have agreed with, but there are also a number of things which was right on. So that's Trump 1.0. Trump 2.0 is similar to that in terms of putting some pressure on the closest low-hanging fruit, being Mexico, Canada, Ukraine, obviously, and Europe. So that's first point. Second point, which I'm surprised again with the markets recently, is their shock at how quickly Trump moved ahead in terms of speaking with Putin, arranging the meetings with the foreign ministers in Saudi Arabia, and so on. And again, I thought, guys, why are you surprised? he's been telling us that he's going to be doing that from 2 years ago. From November the 8th until it was inaugurated, it was a moribund state and there was nothing happening in the world in anticipation of him coming in. So what would you expect him to do? So these are the two sort of changes. Now, so in terms of the philosophical approach, I don't see a difference. What I see a difference in is in the execution, where he's learned the ropes. He knows how to address it. He knows what real power he has and how he can utilize that, potentially having overstretched and having to U-turn a little bit more recently. So I think that's the difference in terms of Trump, rather than the ideological approach and what his objectives are.
And in terms of the geopolitics, you mentioned Russia and Ukraine. I mean, there's been this huge uproar, around the world, especially the Europeans, who framed Trump as saying that he's ditched the Ukrainians and he's backing Putin, and this is terrible and so on. How do you see this? I mean, is it as black and white as that, or is there something else going on?
No, well, again, our view on that over the last couple of years, that is, it's unfortunate for the Ukrainians in terms of the results of this crisis and the campaign. But we couldn't see a situation where Ukraine would regain those parts of the region of the country which the Russians invaded and controlled. So we could not see that going back to Ukraine. Unfortunately, but that's the way we see it. So that's a realpolitik, if you like. So we expect that Trump comes in. He basically says to Putin and Zelensky, guys, let's sit on the negotiating table and let's sort this out. And my impression of what he was going to go through is, okay, what Putin owns, that stays with Putin. Ukraine, you can now start, of course, you can continue the discussion with the European Union, but no NATO. And the difference between what's happened, what I expected, is that I thought he was going to maintain Putin at an arm's length in terms of very slowly easing back the sanctions, partly because of Moldova and Georgia being areas of potential risk in the future. But more importantly, because I felt that he is going to but he's going to keep Putin at an arm's length, which would be beneficial for his bilateral relationship with China. Because the two mega, sort of the two powers, historically, USSR was the big, strong brother, and China was the small one, and now that's sort of reversed. And it's been beneficial for China to have Russia a stable but weaker economy. So I was surprised that Trump has done that. And I don't think he's trying to do a reverse Kissinger by sort of bringing Russia in order to weaken China. Because if he was thinking of doing a reverse Kissinger, then I think he would have mentioned it to his allies, which did not expect that. So that's the view in terms of the realpolitik of what's happening here. And in terms of Europe, and Europe's up in arms, why weren't they on the negotiating table at the outset? Well, they don't have the bargaining chips to be on that negotiating table yet. They don't.
That makes sense. Yeah. In reality, I mean,
it's impacting them more than anyone.
Yeah, it's a US war.
But they don't have the negotiating power to do that. Now, if we do see some tensions, and I'm sure we're going to discuss that further, the Europeans have finally woken up to the fact that transatlantic relationship have. Sorry, I didn't want to move on. Was there a further point before we discuss that?
No, you go ahead. Go ahead.
Yeah, I was going to say that another point, which again I've been finding a bit frustrating over the years, with expectations, is that the transatlantic relationship cracked under Trump 1.0. But number one, it was very clear and evident from the Obama administration, and I'm sure you remember Hillary Clinton's speech in Hawaii in November 2010, November 2011, which was when she made it clear that the U.S. administration is sort of pivoting to Asia. In other words, the focus has to be Asia. So that was a very clear sign that the U.S. is going to be focusing on Asia, number one. Number two, Trump comes in and cracks the transatlantic relationship. But the key point for me is that Biden did not change it. Biden maintained that hawkish stance. And when again, over the last few years when sort of people were saying, oh my God, Trump has been dreadful and sort of what if he comes back in again? I say, guys, 1 second. In terms of Europe, Biden exited Afghanistan without mentioning it to anyone. And only recently in the Financial Times interview, we hear that Macron didn't even have a phone call to inform him that the US was leaving Afghanistan, number one. And number two, he replaced France with Australia in the AUKUS deal, which again, apparently, according to the FT interview, Macron had not been notified about that. So Biden was not really friendly. He did not refix the transatlantic relationship. So it's time that the Europeans have to realize that they need to reassess their strategic autonomy, become more assertive, and find a way of keeping the US close, but at a sort of level playing field, and also potentially bring in China and recreate some sort of a balance of power between those powers.
And I guess it's, as you say, the signs were there since Obama that the US was pivoting towards Asia, and it continued, yet the Europeans didn't do anything. And it seems almost like the Europeans only respond to crises or like dramatic moments. I mean, we know that with Greece and ESM and all the rest. So it's almost like Europe needed this Trump shock in order for them for Merz and von der Leyen to come up with their bazooka package recently on defense.
And on that, Bilal, as I'm sure you know even better than me, but being within the markets, within the sort of the investment bank and the details and the market and the political noise. But it's not just the waiting for the crisis moments. As we know, the crisis, the deadline was always 12 o'clock midnight, and the deal would be done at 4 o'clock in the morning before the markets open. And that was a competitive advantage of Merkel, who, because of her personality and her sort of the rhythms, she was very strong and very alert at 4 o'clock in the morning, being able to have a competitive advantage versus the other leaders. And once that was done, apparently, having discussed this with people who used to work with her very closely, her chief of staff was expected to go back to the office, prepare in writing what was agreed, and back across everyone at 7 o'clock in the morning, ready before markets are open. So that is a very clear example that Europe, as you say, only deals in terms of crisis. The second point was that we also had a very clear leader at that point in time, whereas now there is no leadership. And von der Leyen is there, but she does not represent the voting majority. She is there, but I don't see her taking that Angela Merkel leadership and driving with it. I'm not sure if Merz will be able to do that. Macron had that opportunity because of the domestics. He recently was a slightly on the back foot. We'll see if that changes. And my concern, Bilal, is that Europe cannot, you can't run these decisions by committee. As we all know, with their investment committees, always investment committees, risk committees, but at the end of the day, someone has to take the leadership, take the decision, take the call, and run with it. And we need that in Europe. That has been running. That has been the issue. So I think that this is a very clear wake-up call for the Europeans to take action. Draghi, we've seen the reports. A lot of them are very true and fair changes which need to be enacted. But again, in order for them to take place, it does require a different type of leadership, a preemptive leadership, which thinks ahead of time.
And it feels like, I mean, in the end, you need German leadership. I mean, Germany's the biggest country, so it has to come from Germany, probably. And so you mentioned Merz, you don't think, but do you think Merz has the potential to become that big leader?
Well, the thing is, as we never know. It's you never sort of. We'll see if he does become that leader or not, because he's not coming from a sort of a political background. So we shall see whether he has the ability to do that. The issue which Merz faces, and we can discuss this here, is the elephant in the room, which is an elephant, and that's the AfD. And up until recently, in fact, up until J.D. Vance came to Munich, my view was very much aligned with the main parties in Germany, that AfD, now they're there, so we don't want to deal with them. They're fringe initially, far right. We know the ideology. We've been down that route. We do not want to go back there again. and therefore let's exclude them. Now, and I sort of tend to agree with my wife is Germans who have been sort of traveling to Germany, speaking in Germany, for many years, understand a little bit about that ethos. And I would tend to agree that if that party represents 4 or 5% of your population, you can probably say, those guys, they're sort of extreme. But if that party now represents 21% of your population, potentially, so that's a fifth, potentially even a fourth, if it didn't have a stigma of what it is, you can't really ignore 25 or 20+% of the population in the decision-making process. And when I speak with our clients, it's basically saying, guys, it's like in our industry. ESG is a toxic terminology, but in terms of sustainability and ESG, the whole concept over the last few years is engagement. Would rather engage rather than exclude, because by excluding, you don't deal with the problem. You pass it on to someone who may have different ethos, philosophies, and views to you. So in a similar way, my view, since in fact J.D. Vance mentioned those comments in Munich, I've changed my view. My view is that, somehow AFD should become part of the conversation. And the Germans need to find a way of how do we identify those issues, how do we work with those issues, and how do we deal with those issues? Because the concern, Bilal, is that if they do not deal with that now, and we have Le Pen taking over from Macron in a couple of years' time, and we already know what the other countries, the shift to the far right have been happening, then we could see that AFD becomes the major party over the next general elections. And then that is a true representation of what happened back in the 30s. So my view, which is a shift in policy in my thinking, is that somehow the Germans have to get their act together and be more inclusive and identify and deal with those issues.
And is this an inherent problem now for Europe to be unified if you have these parties like Le Pen's party, AFD, and so on, who are inherently sort of anti-European Union? I mean, or do you not think is that mischaracterization?
I think yeah, because I think that was Le Pen's view before. Maybe she still believes it inherently, okay? But that was her view, and I think that's the reason why she didn't make it. I think it was 2 elections ago, but she learned from the Italians, because the Italians changed from anti-Euro, then they changed, and then they voted in. And I think Le Pen learned from that and adjusted her rhetoric. So I don't think she's going to go anti-EU. The other point, however, Bilal, which I think is very important, as you mentioned, is that, again, talking to some of our clients, they're saying, well, if you've got AFD, if you've got the far right coming through across a broader representation, whether it's sort of Austria or Slovakia and Holland and France and Germany, then doesn't that create the beginnings of the breakup of the European Union with the fringe parties? Not fringe anymore, as in those parties sort of pushing. And my view, we were discussing that, and my view on that, Bilal, is that I don't think so, because I believe that Brussels is also going to shift to the right. Because Brussels is smart. They know that if they remain in this ideological level and everyone else pushes to the right, it will create schism, it will create opportunities for those far-right populist parties to try and separate and exit. Whereas if you see Brussels shifting and adjusting to the right, in order to ensure that they're slightly closer, then that could prevent the breakdown of the European Union. But it does mean that Brussels is going to shift to the right. And not only from an ideological point of view, but also in terms of more pragmatic business sense. We've seen a lot of differences between on the bureaucratic side, on the tax side, on the regulatory side, between US and Europe. I think that Europe is probably going to shift away from that and become more business friendly, less bureaucratic, more efficient, focus more on some sectors, be it defense, be it technology, and see how it can improve its position, especially with the transatlantic tensions remaining elevated, potentially becoming worse.
And one thing people are talking about is the US will essentially become more focused on itself, it will kind of pull back its military resources from around the world. So you'll end up in a scenario where the US dominates the Americas, Europe has Russia as the sort of the regional power, and then you have China and Asia. So you have the three big sort of military powers who control their regions. I mean, what do you think about that characterization?
No, it's not there yet. I can't see Europe yet being able to do that. This is the beginning of that journey for Europe to do that. I still believe thus far it is very much the sort of the US and China calling the shots. But this is an opportunity for Europe to be able to address this issue and take a more to take this opportunity of setting its scene and becoming more strategic and more autonomous. But they need to take action to do that. It does not mean that they are at this point in time.
Okay, great. And then on the US-China, relations now, I mean, what where are we on that? How aggressive will Trump be?
Yeah.
Will it be different to what Biden was doing?
Again, thank you. Thank you for bringing Biden, because we talked about, just to clear, right? I don't have a Biden-Trump view here. I want to be very, very, I've been saying that for some time. I'm trying to be as objective as I can. I'm being critical or supportive to either of them. And the reason I mentioned that is, again, this is another example where I believe that there was a misinterpretation by the market in terms of the foreign policy of the US towards China. Because it is true, Trump 1.0 came out and he said, obviously, number one, where's Putin within the G7? Number two, the whole Europe, you guys should be paying for NATO and you should not be relying on Russian energy and so on and so forth. And the other thing, of course, he said, and he did, is he identified that the bilateral relationship between China and the US was tilted very much in China's favor. So the way that he said it may not be the most diplomatic way, but he identified that this is an issue and I want to deal with it. Fair enough. But it was only after Biden came in place that relationship became more hawkish, or the stance against China became more hawkish. So the Biden administration was far more hawkish on China than what Trump had been. And if you remember, it was I think it was in October 2022, if I'm not mistaken, when Sullivan, Jack Sullivan, put together the Sullivan Doctrine, the thesis. It was the NSA analysis on China, where he basically united the whole US administration against China. They went super hawkish. And only 5 or 6 months later, they realized that they'd overplayed their cards, and they started to send various envoys to try and bring back and become more dovish, which led to that infamous November 2023 meeting in San Francisco between Xi and Biden. So Trump may have initially triggered the tensions with China, but it was the Biden administration which really turned much more hawkish. So to answer your question in terms of US and China, I think what Trump is doing is focusing on the low-hanging fruit. The Mexicans, the Canadians, the Europeans, Ukraine, and I don't believe that he's going to go bang on with China in any aggressive way, because he's very much aware that the consequences for the US are going to be far more significant under that scenario. And I believe, again, we'll see that I don't believe that Trump is ideologically driven, or as much ideologically driven as J.D. Vance may be, or Xi Jinping is. And what that means is that if he pursues a specific avenue and he sees that there's an adverse impact on the underlying economics, the sentiment, the stock market, the economy, then in my view, he's going to backtrack, potentially U-turn, blame someone, sack them, and move on. So what that means is that, number one, he did not go bang on with China immediately because there's low-hanging fruit to be able to capture and prove that as a leader of the free world, you have the power to dictate terms in line with your philosophy. He does not need to take that big battle with China. With China, I believe that the relationship is going to be more constructive, and therefore the adverse impact in policy is not going to be as much as markets feel or expect.
And now, I mean, we've talked about some of these big regions now, and you mentioned markets there. You know, how do you navigate the markets in this environment, like with investors? I mean, what should they do in this environment? You know, we've had a period where there was a big US equity theme, tech stocks and so on. Markets have been worried about tariffs recently. They've sold off a bit in the US. There's this European story. People are worrying about China. How do you translate this to markets?
Yeah, well, from our point of view, the way that we convert the views from basically what we do, from the number one, just to say we don't run any assets, right? So we don't run assets, so we're not biased in any particular way. What we do is we work with asset managers, asset owners, sovereign wealth funds, so basically institutional investors, and discuss with them or advise them in terms of their strategic or tactical asset allocation. And the way that we convert those views into our process is, not surprisingly, based on a number of underlying factors, be it fundamental, valuation factors, market price behavior, but also politics and geopolitics. So the process, if you like, has the weights across these underlying factors, and we use scores, some quantitative, some qualitative, whatever. So in terms of geopolitics, the contribution of geopolitics into our process has been positive. Even in the Middle East, when was in October, I remember it was October 7th, but in October 2023, when Hamas attacked Israel, and everyone was sort of saying, oh, this is going to be sort of significant and the price of oil is going to skyrocket and everything and so on. We did not agree with that. We in fact wrote a paper saying we think that the Middle East is not as fragile, to use Talib's term, is not as fragile as the markets expect. Number one, because the lines of communication are open. China opened the line of communication between Iran and Saudi Arabia in March 2023. And also through the Abraham Accords, the official line of engagement or communication was open between Israel and the Arab states. Privately, they were always doing business, but formally, officially, that was open. So with 2 lines out of 3 open, the unintended consequences of the left-hand event were reduced. Point number 1. And point number 2, in the middle of that sort of triangle, we had Saudi Arabia, because Saudi Arabia may have benefited from a higher price in oil, which would have benefited Russia and Iran, but they also knew, MBS was very much aware, that if the price of oil went up to 150, 200, 300, it would create inflation, central bank policy tightening, global recession, which would be disadvantageous for Saudi as well, as it was looking to diversify away from fossil fuels. So therefore, we had a more constructive outlook on geopolitics, scoring positively across our scorecards on the back of that. Now, more recently, if we're looking at the latest events, the factor which has basically maintained, we've been positive, Europe, UK equities, China, but would be neutral, Japan, and the US. And in the US, we had some views, a number of sectors, I'll talk about them in a second. But the reason why we've been neutral, the US, has not been on geopolitics. The fundamentals have been positive, not super positive, but it's going sort of a +1 out of a +3. Market price behavior has been okay. Politics have been constructive. Geopolitics have been okay. But the one thing which has been weighing it down is valuations. So that's the reason why, in terms of the S&P outlook, we've maintained a neutral view because of the valuations. Now, from a sectoral point of view, we have had opportunistic views. For example, we were positive consumer discretionary from February 23 until until a few weeks ago. Or we may have ad hoc views on energy, on healthcare, on communication services. But in terms of the S&P, we have been neutral. And where we have been positive is Europe and the UK. And we've been positive Europe, for some time. And, about October of last year, we were getting a lot of pushback in terms of our European.
I can imagine.
Well, the economy is worse and is weakening and everything. And why? And my view was that, yes, okay, the economy has been weak, but it had, in terms of some of the indicators, we're starting to see signs of a positive development versus expectations, number one. Number two, it was cheap from a valuation point of view. And more recently, we upgraded the score on politics. So market price behavior obviously has benefited, but also on the politics for two reasons. Number one, because of the wake-up call that the Europeans have to take action and invest, whether it's across the various industries. Number two, because we feel, born with pressure of the US, that from a regulatory point of view, they also have to ease back on the bureaucracy, which will open up the channels of capitalism within the system. That I think is interesting. And also from a little bit of a bottom up, we've also seen some improvement in the net earnings revisions. So expectations over the last few months have been improving. So we've been on the right side of Europe and the UK. And
on this European story, I mean, do you think it has legs to run, for the whole year, or is this more of a kind of a tactical view for 1 quarter, 2 quarters?
I think, well, obviously we will see. This is an ongoing, so we look at the process on a continuous basis and we adjust. So our views can be for years, but we always look at it on a monthly basis and then on a quarterly basis. So I don't see a reason why that may particularly change. The key point being that the US is still expensive from a valuation point of view. But number two, I don't think investors are overweight Europe. I don't think investors are overweight China. And then again, we're also positive China. We can talk about that in a second. So there has been a surprise in the pickup, in the outperformance of the European sectors. There's a lot of underinvestment. There's still a lot of work which needs to be done in terms of the financial sector with all the amalgamation. So there is a lot of opportunity set in terms of the efficiencies. And I think that investors are still underweight that part of the world.
Okay. And you mentioned China. One criticism people have towards China is that there's no real domestic demand. They're export-led right now. They haven't really done any big stimulus. So why, so why do you overweight China? And then you have the US attacking it, through tariffs or potential tariffs. So, but you're positive on China.
Yes, we are. We're positive on China. Now we have two strong. I was having this discussion with a client of ours, and I was talking about China, and one of the guys on the table said, "Are you positive China? Is that a hope trade?" And I turned around and I said, "It's not a hope trade; it's a belief trade." And what I meant by that is that there's two beliefs, two strong beliefs, and a belief which may not be as strong, but it's coming up. So the two strong beliefs are, number one, that Powell is going to remain super orthodox. And if anything, he's the one person who can really stand up to Trump and win in that battle. He will remain orthodox and we can talk about that separately, if he sees the inflationary pressures coming through, he will raise rates. This is our view. We wrote recently about that. We think that the Fed is still likely to raise rates in September. So one belief is that Powell will raise rates if inflation is getting out of control. Inflation expectations are starting to move higher because they cannot be seen to be wrong twice in such a short period of time, the first one being COVID. So the credibility is number one. So our belief is that Powell and the Fed remains super orthodox. That's belief number one. Belief number two is that Xi Jinping needs to maintain economic growth to ensure social cohesion in order for the Chinese Communist Party to stay in power. Now, you rightly alluded to the fact that they have not provided a bazooka. And they would not provide a bazooka, and they're not going to provide a bazooka because Xi Jinping is political ideology is different. So he basically shifted the Chinese economy from being capitalism with Chinese characteristics to the left over the last few years. And the impact on the various sectors, Jack Ma, speculated bubble blowing it. Why did he do that? Well, he did that because he learned from the USSR. He learned from the collapse of capitalism 1.0, which was the GFC. And when the GFC created the collapse of the capitalist system that we know, number one, China came to the rescue, and we saw what happened in terms of the stimulus and the government involvement. Now, if China's speculative bubble had continued to expand and burst, no one's going to go help China. So I felt that Xi Jinping felt there was an existential risk. And in order to avoid the mistakes of the USSR and the US, he felt it may be costly, but it's better to do it now and prick that speculative bubble and deal with the consequences rather than have an existential problem of the potential of the CCP and the whole society collapsing. So obviously that happened at a time when COVID happened, which was unfortunate for them. And he was also dealing with the whole Jack Ma situation, because I felt that he could see that as a potential threat, someone or a group of people with the financial power and the stimulus and the presence in order to challenge, if you like, even on the sidelines, the prestige of the CCP. So he dealt with that as well. But to answer your points, he therefore shifted the economy from the capitalist system to the left, to sort of more communist Marxist system. And the way that he's been dealing with the stimulus is as little as necessary. So rather than throwing a bazooka in the way that they did in 2008, they've been doing little by little by little by little, which is never seen as enough by the markets. And that, I think, is intention. Do as little as possible. Now, does that mean that he's going to turn the economy around? I believe, and this is the belief issue here, I believe that they will turn the economy around, but China is not going to go back to what it was with an 8% growth. It's going to be a positive, +5, 4.5, 5, stable, but a diversifier in terms of asset classes in the portfolio, a very key significant component of the global economy, which you cannot avoid. And the reason why we like it, we maintain that positiveness, is because from a valuation point of view, it's super attractive. So you've got positive fundamentals. The market price behavior is not that great. The political support is there. We still score it positively geopolitically because we don't see that tension happening. We can talk about China and Taiwan separately. And valuations has that opposite score. So the US is a -3 score in valuations, and China is a +3 score in the valuations.
But how about tariffs? So US has imposed 20% tariffs so far. If it goes up to 60%, I mean, wouldn't that hurt this China trade?
Well, it would hurt China, but it would also hurt the US. So, and it goes back to the point I mentioned earlier that, I mentioned the two beliefs. There was the two beliefs. The first belief was the Powell belief. The other one was the Xi Jinping CCP belief. The third belief, which I mentioned, is sort of, wouldn't yet put my neck on the line on that one, but I think it's brewing as a strong belief, is that Trump will U-turn if he sees that his policies are creating adverse economic sentiment. So if, for example, and we already saw some U-turns, some recent U-turns on Mexico and Canada, that's one recent example. But I do believe that if he were to pursue some strategies which triggered a negative first quarter growth in the US or the S&P another 15% lower, then I think that's where he turns policy, sacks someone to blame someone, and then continues. So in terms of US banking with China like that, China is going to retaliate, adversely impacting the US and bringing them then lower. So I'm not that concerned on that. I'm not concerned. So, the probability of the Chinese dumping treasuries, because if they were to dump the treasuries, immediately 10 years would spike, immediately recession within a month. It's not in their benefit to do that. So I don't see that as credible. And one of the reasons we like US 10 years is even though we expect the Fed to raise interest rates, is because, number one, they offer positive real yield. Number two, because the Fed will maintain inflationary expectations contained. And number three, it's a diversifier on the overall portfolio. And we don't see China dumping treasuries in order to make a spat with the US.
Now, I have to come back to your point about Fed raising rates.
Yeah.
Obviously, that's a very non-consensus view. What's the basis for that? It sounds like it's in inflation.
Yeah, I think that's Bilal. It's we don't. It's not our view to go out of our way to create contrarian views, right? We're not in the business of we want to raise contrarian views and sort of highlight difference. We're not in that sort of business. We don't think like that. But sometimes some of our views turn out to be contrarian, and this one was one where in November of last year, the underlying economic data was showing a clear sign of a pickup, of an expansion. We had already been expecting a Trump win since April 22, basically. We were calling for a Trump win. So we were expecting that Trump win to take place. And what we didn't expect is for him to win the way that he did, right? Everywhere and across the board. But once he did that, so once we had a clean sweep around everything, plus the economy was showing signs of a clear expansion, we basically started raising the discussion that, if inflationary pressures start getting out of hand here, and if Trump were to pursue the policies that he's talking about, then inflation could surprise to the upside. And guess what? The Fed is not going to sit back and allow it to happen. So to answer your point, so we started talking about it in November, and then in December, we shared that as a critical viewpoint with our clients. And in January, we wrote the piece. The FT kindly asked us to convert that analysis into 750 or 700 words, which apparently it took me more time to convert the analysis into 700 words than putting the whole analysis together, right? I mean, good on journalists for being able to do that. Anyway, so the point there is the following. Number one, the US economy. The US economy has been resilient. The levels of employment are very steady. And in fact, if you look at the sectoral levels of employment, so if you look at manufacturing, residential construction, temporary help services, these three have been leading indicators of a potential US recession for decades, with the exception of 1973, when the recession happened without a weakness in employment. So these are the three key level 1 and level 2 sectors: manufacturing, residential construction, and temporary help services. And we've been using those as key leading indicators. And temporary help services is off, but the other two are not. There's no sign of weakness. In fact, recently there's a little bit of a sign of weakness, but not much. So historically, we haven't had a recession apart from 73 without these weakening. Then you may say, well, what about information? Information, this as a sector yet, that has been coming off, but not too much. It's down 3.9%. Now it's a little bit lower because of the revisions, but it's about 4% from its highs, similar to October 23. So no concerns on the employment side, number one. Number two, the underlying economic data were improving. And number three, our view was that inflation will range strength between 3.5 and 2.5, and we could see that it was sort of bottoming out and starting to pick up. So our view was that the US economy is on a strong foot and an expansion, number one. Number two, we have the Trump policies. And in our view, all of the Trump policies were expansionary, not potentially inflationary. Whether it's the tariff cuts, the tax cuts, the tariff cuts, the deportation, even Dodge, we felt that sort of potentially opening up that opportunity set and building the chance of expansion. And if you have a strong economy with the potential impact of the Trump policies, which drive inflation and inflation expectations higher, the Fed, which is the third point, needs to address that. It's the Fed's credibility. And given that they were wrong just a few years ago, how cannot be wrong twice in such a short space of time? So our view is that in the first quarter, they just sit back and watch what happens. In the second quarter, if we are seeing the impact of this starting to drive expectations and prices higher, they're going to start warning or threatening behind closed doors. And in the third quarter, September, they started tightening. Now, two caveats here. Number one, if Trump were not to do any of the policies, nothing at all, then the economy on its own would not require rate hikes. because we are already in a slightly tighter environment. And Powell mentioned that. So if it was not for the Trump policies, I think the US economy on its own would not need those rate hikes. It's on the back of the action which Trump policies are taking, which will then create in my view, the expectations for that to happen. Now, since December, since we started writing that, in December, people were expecting 4 rate cuts. Powell corrected that to 2. It went down to 1 in February, and now it's back to 3 again. So obviously as you said, it's a contrarian view, but it's one that we're sticking with for the time being.
And just from a thematic perspective, you mentioned the information sector, but obviously a big theme that a lot of investors are thinking about is AI. So from an asset allocation perspective, an SAA or TAA perspective, strategic asset allocation, tactical asset allocation, how do you think about exposure to AI, or is it too rich to have exposure right now?
It's no, we look at that. There's a number of ways you can look at it. So that would be as part of the strategic asset allocation within the underlying asset classes. So we would not, for example, allocate a particular percentage in AI. It would be part and parcel of whether it's on the fixed income side, whether it's on the equity side. But within that, if we were to look at the asset allocation within the equity components and the sectors, if you look at our underlying components in the model, technology until recently was number 1, but it had the most expensive valuations. So our preference, rather than being in technology, we got the communication services from February 23 for about a year and a half. So we benefited from that component, but more recently, we felt the valuations are stretched. Even in consumer discretionary and healthcare, we decided to reduce that and go back to neutral in February, because we felt that in terms of the risk units, we'd rather have our risk units in places such as Europe or UK or China, where the underlying valuations were more attractive. So we would not be underweight. We're not underweight, we're not negative, but we are neutral on that space. And I think something else to mention, which brings in again the discussion of China, as you probably noticed, that Jack Ma was back in vogue again. The rehabilitations come through. He was in the front row. He was seen sort of very, very much in play with Xi Jinping and the policy. And I think this is interesting because it just shows that I think Xi Jinping was pleasantly surprised with the developments of DeepSeek recently, and he may be potentially seeing that particular sector forming part of the competitive advantage of the state. Now, how do you bring in tech and AI as part of the broader state? We'll see if and how that happens, and whether that in itself will be able to add shareholder value for Chinese, for investments into China. But certainly it's something which is very attractive. But in terms of the US, we would not be overweight. We're neutral in that sector.
Okay, great. Now, I did want to round off with a few personal questions. One is, obviously, you've been in the industry for a while. I mean, what's some of the best investment advice you've ever received from anyone?
It's not about investment advice. It's having gone through, as yourself, having been sort of in the industry for decades. Our view is always to sort of be very aware and sort of always question and challenge what you think you know. Is it true and fair? And how do you challenge yourself in terms of being open to criticism and questioning all of your thesis, all of your expectations, number one. Number two, I know it sounds cliche, but it is very much a case of diversification. And number three is risk management. That's in essence, the three key components. Yeah. And obviously some sectors, for example, the currency sector, you tend to be a little bit more humble because there is no underlying data which makes you sort of very confident of yourself. So you always keep a sense of realism because there are there's some views you get right and some views you get wrong. So you need to be very sort of aware and transparent in terms of the process and being in a position where you get challenged with your team, your friends, even your clients, and keep a very open mind in terms of challenging and questioning yourself and your process.
No, that makes sense. And we do have some young people listening to podcasts as well. So what advice would you give to people leaving university this year, say, as they enter the real world?
Guys, it's a passion. My view is, and I have this discussion with my two sons. I've got a 17-year-old son and I have a 12-year-old son. And it's about a passion. It's not a 9-to-5 job. It's a job really which is full engulfing. I think it's one of the few, in my experience, careers which is impacted by everything. Whether there's an earthquake, where is the social unrest in a particular town, whether the geopolitical developments, inflation, everything which happens around this world is impacting this particular industry. And this is an opportunity for you to enter this industry and really be able to make some change, whether it's through the policy side or whether it's through the institutional side. But that is a personal commitment which requires passion, and it is not a 9-to-5 job.
That's great advice there. And the other question I had was on books. Are there some books that have influenced you, or some books recently that you've liked?
You know what? It's not from a business point of view. I mean, there's fantastic sort of books in terms of business, but I tend to enjoy, apart from the sort of the book on Elon Musk by Isaacson. I mean, that I think one needs to read that, and in my view, why read that? Because it shows a little bit of an insight to someone who has been driving policy and, if you like, created that change in the political environment in the US. So who is this guy? What's his background? What is he thinking? What ticks? What are the risks? What are the issues? So a little bit of an understanding about the background of the man. Or, for example, during the Eurozone crisis, after that, another book which I thought was very interesting was Varoufakis' book, Adults in the Room. And I know a lot of Greeks were very critical when I was reading that book because he's a very controversial figure. I said, guys, we need to read him. We need to understand, given who he is and what he's gone through, what's his view? What did he see? How does he see it? Whether you agree or disagree with what he said or what he did or what he represents. So again, it's going back to being open and identifying and understanding a little bit more rather than just reading which is of course important, the Financial Times or the various newspapers and articles and Booking Institute reports. But on top of that, I think, on a personal point of view, it's reading a little bit more broadly. Like one of my favorite books is it's not a trilogy, it's a 4-book trilogy by Robert Caro on Lyndon Johnson. The beauty about writing or reading those 4 books is that he manages to mix together, giving you a glimpse of what the US society was from the late 1800s. Number 2, LBJ as a man, as a person, what he did, how he did it, the issues he was facing back in the sort of 60s, but also how was his relationship with the Kennedys, the pitch for the vice presidency. And the third component is where he explains how the US system works, the differences, the 2 houses of Congress, and how the intricacies and how things get done. So it's slightly different books from the business side, which help. And if you like, maybe because of my Greek sort of background, a little bit of poetry, like the Cavafy, there's a whole thing about Ithaca. It's not about the destination, it's about the journey. Enjoy the journey, take your time, appreciate it. And there's ups and downs, and learn from your downs. Of course, there are going to be downs. You need downs, otherwise you don't learn. But how do you learn from them? How do you progress? How do you sort of get up again and fight?
No, that's great. That's fantastic. Now, final question. If people wanted to reach out to you, follow your work, what's the best way for them to do that?
Well, they can send me a LinkedIn message, of course. It's very difficult for us. We don't share the views that we do. Very simple reason that obviously there are asset managers out there, great asset managers who do the analysis and then they share their research. But sharing their research is marketing for the assets they manage. For us, what we do is the research and the analysis and the SAATA. So we don't share that, but always happy to have a conversation and guide or suggest things and views with people. Of course, not investment advice, clearly.
No, that's fantastic. Well, Thanos, that was fantastic. We covered a lot of ground. You're doing a great job. Keep up the good work. And thanks a lot for coming on the podcast.
Always a pleasure. Thank you very much for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.